Welcome students. Today let's understand the cost sheet format, or it's also called as cost sheet pro forma, and how to calculate cost. So this is the cost sheet pro forma. So if you start looking at the format, it is very evident at the beginning all the three items of cost are direct. So let us start with direct material, then you have direct labor and direct expense. In the direct material, there is an adjustment which is required. Why this adjustment? When we are computing the cost sheet of a product, of a cost object, you have to consider the material consumed. So this adjustment will give you material consumed. What you have to do? Take purchase, add opening stock, subtract closing stock, add any incidental charges such as freight or insurance. Then if there is any scrap or material return, that also it has to be subtracted. That is the direct material. In the direct labor, this is nothing but the labor cost or the earnings as per whatever method the organization uses. It can be Taylor or it can be Rowan. So using that, whatever labor cost the organization calculate comes in direct labor. Then is the direct expenses. Most of the problems are silent on direct expenses, but you have to pay attention if it is there. If you add all of this, what you will get is the first subhead, which is the prime cost. That means you have to subtotal it at prime cost. To prime cost, you have to add production overhead, or it is also called as factory overhead or works overhead. So all these are different nomenclature of the same item, which is the overhead at factory. You have to add production overhead and do an additional adjustment. Again, this is the additional adjustment with respect to WIP, work in progress. When you do that, you get another subhead called factory cost. So this is the first subhead, prime cost, second subhead, factory. To this you have to add administration overhead. You will get cost of goods manufactured. To the cost of goods manufactured or cost of production, also called as COP, cost of production, you add another adjustment of finished goods. So add opening minus closing. You will get cost of goods sold or COGS. So cost of production was the third subtotal. Then you have four subtotal, which is COG. Then if you add selling and distribution overhead, you get cost of goods sold. Let us understand with respect to one simple process what you should do if you get a cost sheet problem. So typically two set of data will be given in the problem, one related to current year and another related to previous year. First step is all direct cost till prime cost has to be directly taken for the current year. Indirect cost you have to calculate using recovery rate. So indirectly it will be given in the problem. You have to take that. You will get something like per hour or per piece basis of overhead recovery. That you multiply with the hours or pieces, you will get different overheads. All these indirect will be calculated there. Then when it comes to the profit, so you have to be careful whether profit is given as a percentage of cost or it is given as a percentage of sale. To give an example, 20% of cost is equal to 25% of sales. So these two values are different. Hence, attention has to be paid when calculating the profit. So let us understand this with one simple problem. So pause here for a moment and read the problem carefully. Note down all the numerical values which are given. So I hope you have gone through this. So you have to produce 4000 numbers of a component. Capacity is available, but you have to have a fixed investment of 50,000 and working capital to the extent of 30% of sales value. This additional is required if the job is taken. Then what cost data is given? Material. So this is direct material given. When you have to calculate total, so you have to multiply 30,000 pounds into 2.5 per pound. Second head is labor hours, direct 25,000, of which 5,000 would be overtime payable at the double rate. So when you have to calculate labor hours, you have to take normal, then you have to take overtime. So two amounts will come. Labor rate is given, so multiplied by rate, you will have to calculate using the labor rate. Factory overhead, 1 per direct labor hour. So factory overhead recovery rate is given. Total 25,000 labor hours, so 25,000 rupees. Administration overhead directly given, selling and distribution overhead directly given. The company expects a net return of 20% on the capital employed. Material recovered as scrap at the end of operation is estimated at 1000 rupees. So first head, this is a simple cost sheet problem. There is nothing much to do it. So before I solve it, you apply your mind. First you need direct material. Like I told, there are adjustment. So one is your 30,000 into 2.5 minus scrap value. Then direct labor hour, you have normal and you have overtime. there is no direct expense, so this will give you prime cost, plus factory overhead. Factory overhead is at 1 per labor hour into 25,000 hours, so this you will get factory cost, plus administration overhead given directly, you will get cost of production. Then there are no adjustment of finished goods, so this cost of production is cost of goods sold, plus add the S&D overhead, which is 20,000 directly given, you will get cost of sale, plus profit, you will get your sales, correct? So here up to cost of sales all the data is given, profit you have to calculate based on 20% of the capital employed. So I have solved it here. Direct material given, then scrap is adjusted, direct labor in two parts, one normal and one overtime. So here you will get prime cost 96,500. Factory overhead 25,000 is applied at 1 per hour, 25,000. Then all administration and S&D overhead is direct. So your cost of sale is 154. So cost of sale, how to add the profit? Profit is 20% of capital employed. What is capital employed? Fixed capital and working capital. If you look at the problem says you need a fixed investment. This is the fixed capital of 50,000 and working capital to the extent of 30% of sale value. I also don't know sale value. So what I will write? I will write it as, so sale is equal to cost of sale plus profit, correct? So sale is equal to cost of sale is 154 plus profit is 20% fixed capital, 0.2 of fixed capital plus working capital. Fixed capital is 50,000. So 50,000 into 0.2 is 10,000 plus working capital is 30% of sales. So I will represent working capital as 0.3s. So 0.3 into 0.2 becomes 0.06s. So if you take this sales on this side, this will be 0.94s is equal to 1,64,000. So S becomes 1,74,468. So once you know sales and cost of sales, the balancing figure will be your profit. Hope you have understood. This is a simple problem. Let us go for another type of cost problem. So pause here for a minute, take a screenshot and identify all the data which are given. So let us start. So there is a company which manufactures tiffin boxes and installed capacity is 1.2 lakh units per year. Here you have all the data which is respect to the unit. Then they have given the detail about the semi-variable overhead which varies with different capacity percentage. And also the 50% capacity is applicable for first 7 months. Then 75% for the remaining months of the year, remaining 5 months. So that means the variable overhead will change. The selling price is fixed at 69 per unit and the firm has been monitoring the profitability and revising the selling price to meet its annual profit target of 8 lakh. So that means from first 7 months and the last 5 months, the overall profitability required is 8 lakh. So what is the selling price which is required for the next 5 months? So if I break down this problem, all you have to do is you have to calculate 7 month, then 5 month. You have to draw a cost sheet. You have direct labor, direct material, labor, expense and other things. So you will get prime cost. To this you have to add a variable overhead. Here you do not have segregation of factory, administration and selling and distribution. Instead you have fixed, variable and semi-variable. First you add variable overhead, then you add semi-variable overhead. So semi-variable overhead, here it is 50%, here it is 75%. Hence this is different. Then you have fixed overhead. So fixed overhead I will distribute over 7 months and 5 months. Then I will get my cost of sales. After this I have a profit or I have a selling price. Here it is 69. Here what is it? My total profit required is 8 lakh. So this is my profit 1 and this is my profit 2. If I add both of this, I should get 8 lakh as total profit. So let us see. So let us see it in a table. So I have divided it into two columns. One is 7 months, another is 5 months. Here capacity is 50%. Here the capacity is 75%. Because of this, in the semi-variable overhead, here I am considering 7,500 and here I am considering 7,500 plus 2,500. So this is taken care. Fixed overhead is divided equally into all the months. So this is also taken care. Variable overhead is with respect to the number of units. This is taken care. So when I do this, I will get cost per unit for the first period as 57. And then selling price I already know 69. And when I do the math, 69 minus 57, this is the profit I will get. To get the total profit of 8 lakh, the profit I should get in the next 5 month period is 3,62,500. When I know this and when I know cost per unit, I can always calculate my selling per unit. So this is a second type of problem. This is a third type of problem, which is also, you can get it in the section of job cost. So pause here, study the question. So this question has appeared once or twice in the examination. Similar questions you may get in this examination also. It's a simple problem, but it will test your fundamentals. So what you have to do, you have to make a cost sheet and prepare an estimation. To do that, you have to follow your cost sheet pro forma, so which starts with your direct material. In this question, these are your direct material. Also, your primary packing also is a direct material. Then some photography is required, but it is through an agency, not your direct labor. This is your direct expense, and the detail given here is required to calculate your direct labor. How do you do it? From this you derive per hour cost and multiply whatever hours are taken for this job. So with this you will get prime cost. The production overhead, 30% of direct cost. So production overhead you can, or factory overhead is at 30% of your prime cost. Selling and distribution are 20% of production cost. So this is your factory cost or production cost plus administration overhead. So administration overhead is not there. You can directly take selling and distribution over. The agency expects 20% on the quoted price. That means cost plus 20% of S is equal to your S. Substitute all the data in this cost sheet pro forma and try to solve this. Now time for the answer. Like I told, direct material, you have the data including the primary packing material, you have 40,000. Then direct labor converted based on per hour, you will get this data. Then direct expense is photographer on hire. So your prime cost is 70,733. Add 30% to that, you will get factory cost. There is no administration overhead. Then add 20% to the factory cost, you will get your cost of sales. Profit is 20% on sales. So sales you will get first, then you will get balancing figure as your profit. Students, that was it. If you have any questions or doubts, you put it in the comment box. I will definitely answer to them. So that's all for today, students. Practice cost sheet pro forma. This is very fundamental for cost accountants. So you have to by heart this cost sheet pro forma, and whenever you get any problem, try to identify which head is this data relevant to. So thanks for watching. If you have any queries, drop it in the comment box, or if you have any request of solving an additional question, you drop it in the comment box. I will address it.